Symposium to take you live now to Senate Banking Committee Chair Christopher Dodd. He'll be unveiling a financial regulations bill after months of negotiations with committee Republicans. This is live coverage on C-SPAN 3.
2 years ago today, on the 15th of March, 2008, Bear Stearns, a fixture of the American financial system for 75 years, was collapsing. 6 months later to the day, on September 15th, 2008, Lehman Brothers filed for bankruptcy. Today it is tempting to see those shocking failures as the beginning of a crisis that has claimed millions of jobs, billions of dollars in retirement savings, and trillions of dollars in American wealth. But the truth is that those historic collapses weren't the beginning at all. The crisis that has led to so much economic carnage in the lives of middle-class Americans was caused by the long-standing failure of our regulatory structure to adapt to our changing financial systems and prevent the sort of dangerous risk-taking that led us here. The economic damage that resulted from those failures tears at the very fiber of our middle class. While some of the most prominent American financial institutions have been destroyed or badly weakened, the far worse damage has been done to millions of American families who did nothing wrong at all. A staggering 8.4 million jobs have been lost, and the unemployment rate remains near double digits in many areas. Nearly 7 million have lost their homes to foreclosure over the last several years. Millions more have lost their retirement funds or their small businesses in our country. Americans are frustrated and angry, as we all know. They've lost faith in our markets, and they wonder if anyone is looking out for them. Worst of all, as I stand before you today, our regulatory structure, constructed in a piecemeal fashion over many decades, remains hopelessly inadequate. There hasn't been financial reform on the scale that I'm proposing this afternoon since the 1930s. Let me be clear. We are still vulnerable to another crisis, and neither I nor anyone else can tell you with any degree of certainty that the American economy could survive another crisis of this magnitude. It is certainly time to act. Some have suggested that we should wait a little longer to take up financial reform. To them I say, how much longer do you want to leave your economy and our middle class as vulnerable as they are? How many more jobs lost, homes foreclosed, retirement savings diminished? 3 years ago this week, the Banking Committee had just finished its first set of hearings on the wave of home foreclosures. Since then, our committee has held dozens of hearings and spent thousands, literally thousands of hours on this legislation. We have listened to hundreds of perspectives from experts in a wide variety of fields. We have examined and re-examined proposals sent to us by the administration and many, many others. We've worked in a bipartisan fashion, or tried to reach as much consensus as possible. And the bill that I'll be presenting today reflects the input and ideas of my friend and colleague, Senator Shelby of Alabama, and Senator Bob Corker of Tennessee, as well as many other members of our committee, Republicans and Democrats. And so I want to begin these remarks by thanking my colleagues on the committee, all of them, for their hard work over these past many, many months. But our work must go forward. The legislation I'm offering today is comprehensive in its scope because the crisis it aims to solve is comprehensive in its scope, not to mention the tragedy of its consequences. We must restore confidence and optimism in our economy, accountability in our markets, and stability to our middle class. The point of this reform bill is not to punish the financial services industry. I know how angry people are at the mismanagement that led to this crisis. But legislating anger isn't the way to solve these problems. This legislation has three main goals. First, we must plug the gaps and eliminate the inefficiencies that allowed this crisis to happen in the first place and still exist today. Secondly, in addition to looking in the rearview mirror, we must look through the windshield. There will be shocks in our system in the future, for certain, and we need an early warning system so that the next time it occurs, our system is prepared to deal with it. And thirdly, we must protect American consumers and honest businesses so that they can, and we can, restore optimism in our economy and confidence in our institutions, renew the flow of credit and capital, reestablish America as a world leader in financial services, and, of course, to rebuild a strong foundation to create jobs and prosperity for all Americans. The bill I present today has 11 titles, many of which reflect bipartisan consensus. Let me briefly discuss the 4 major reforms in this bill. Not all the reforms, but the major ones. First, the legislation will end too-big-to-fail bailouts. Never again should the American taxpayer be asked to write a check because of an implicit guarantee that the federal government will bail out a company when it collapses would threaten the stability of the economy as a whole. Companies simply shouldn't be that big or that complex. It isn't safe for our nation. And we will discourage that through the new capital requirements and other strong supervisory protections. Meanwhile, when large, complex companies do fail, they will be shut down through bankruptcy or resolution in a way that doesn't threaten the rest of our economy. Senators Mark Warner of Virginia and Bob Corker of Tennessee have been invaluable in shaping this part of the bill, and I want to publicly thank both of them for their tireless effort over these last many weeks. Secondly, this legislation will create a strong and independent consumer protection watchdog. This crisis started when people were given mortgages they didn't understand and could never afford. If there was a watchdog on duty, it didn't bark. We need to strengthen not only its bark, but also its bite. I know there's been a lot of attention paid to which building this new watchdog will be housed in. That's not the important part, let me say. The important part is that the Consumer Protection Watchdog has the independence and the authority it needs to get the job done. The watchdog in this bill will have an independent head appointed by the President of the United States and confirmed by the United States Senate. The budget for this agency will be independent to ensure that it can't be smothered by a refusal to provide it with the resources it needs. It will have autonomy to craft rules and the ability to enforce those rules. It will be there to protect consumers from the abuses that we've seen become almost standard operating procedures: skyrocketing credit card interest rates, the explosion of checking account fees, predatory lending by mortgage firms, and much more. Third, this legislation will create an early warning system so that someone is tasked with looking out for the next crisis, which will surely come. We will create a systemic risk council with a job of scanning the economic radar to identify unsafe products or practices that could threaten our economic stability, and the authority to stop them when they occur. We were caught off guard by the subprime lending crisis. We cannot ever allow that to happen again. And fourth, this legislation will bring transparency and accountability to exotic instruments like hedge funds and derivatives that have for far too long lurked in the shadows of our economy. These activities left investors open to tremendous risks they didn't even know existed. Billions of dollars were traded, or perhaps the better word is gambled, behind closed doors. This, too, must stop. Now, the discussion draft that I introduced in November contains very strong measures to bring transparency and accountability to these sectors of our financial system. And the legislation I present today includes similar strong language with some changes. Senators Jack Reed of Rhode Island and Judd Gregg of New Hampshire, like Senators Corker and Warner, have done tremendous work over the past number of months, and they're continuing their work on this section of the bill as they try to reach consensus. It'll be incorporated, if they are able to do so, in the legislation when it's ready. Meanwhile, we will rein in the insane compensation packages that have outraged the public and hurt our financial system by rewarding short-term profiteering and wild risk-taking. I want to commend Senator Chuck Schumer of New York for his terrific efforts in crafting these reforms that are included in this proposal. There's more in this bill. For instance, it creates a new program at the SEC to encourage whistleblowers. The bill imposes more accountability on credit rating agencies. The bill cracks down on conflicts of interest at the Federal Reserve, making the head of the New York Fed, for example, a position appointed by the President of the United States and not handpicked by the very bankers the New York Fed is responsible for regulating. Our goal in the legislation is to end business as usual and create a system where honest businesses, large and small in our nation, can thrive on a level playing field, where middle-class families can find work and invest with confidence. The legislation I present today contains bipartisan ideas and is the result, as I mentioned earlier, of a bipartisan effort. It does not, as of yet, of course, enjoy bipartisan support.